Hey guys, what's up? I'm Erin and welcome back to the channel. Dividend investing can be a truly appealing investment style. It's the ultimate passive income, and who doesn't love a good stream of passive income? All you have to do is invest in dividend paying stocks and then sit back and wait for them to pay you simply because you chose to invest in them. What could be better than that? Whether a stock pays a dividend or not is listed under the stock information section. And a dividend is listed as something called the dividend yield and is listed as a percentage. Let's look at the company 3M, for example, which is a very well-known dividend-paying stock. The dividend yield for 3M is 3.23%. Now, how do we translate that on over to what your dividend payment would be if you owned the share of 3M? Well, it's pretty simple. All you have to do is take the current share price, multiply that by the dividend yield. In this case, you would take $183.37, multiply that by 0.0323. We're moving the decimal because it's a percentage, which gives you $5.92. Most companies typically pay their dividend payment in quarterly installments, so 4 times a year. So in our situation with 3M, with their dividend payment of $5.92, that's actually the dividend payment for the entire year. But it's actually going to be paid out in 4 quarterly installments. So each of those payments would come to about $1.48. So it's pretty easy to see that you're going to need a few shares if you actually want to live off your dividend income. Continuing on with our 3M example, you would need over $1.2 million invested in order to earn an income close to $40,000 a year. That's a pretty significant investment. Now, of course, 3M isn't the only company out there that pays a dividend. There are many different routes to dividend investing. And not all companies pay out a dividend. It's fairly uncommon to have emerging companies or growth-oriented companies or even tech-based companies that pay out a regular dividend. Think Tesla, for example. They've never paid out any sort of dividend. And this makes sense, because these companies are more interested in pouring the profits back into the business itself, developing new technologies and growing the business. So rather than paying out the profits to the shareholders, they take those profits, reinvest them in the company, and hopefully build a bigger, more successful company. Even Apple, very much a tech company, didn't start paying a dividend until the year 2012. To put that into perspective, Apple was founded in 1976. They went public in 1980. The iPod first came out in 2001. The iPhone came out in 2007. So yes, while they do indeed pay a dividend today, that has not always been the case. In fact, it's a fairly recent addition. The companies most likely to pay a dividend are those larger, more mature, well-established companies. And the companies most well-known for their dividends are companies known as the dividend aristocrats. Presently, there are 65 dividend aristocrats. The list does change periodically, as in order to be classified as a dividend aristocrat, a company has to meet some fairly strict metrics. 1, they have to have paid and raised their dividend payments for the past 25 years straight. Miss once and that clock starts all over again. 2, they must be worth at least $3 billion. And 3, have an average trading volume of at least $5 million per day, meaning that they are very well known and very heavily traded stocks. The companies that make up this list are the companies that you are pretty much guaranteed to know. Think 3M, AT&T, Coca-Cola, ExxonMobil, Sherwin-Williams, Target, Walmart, and many others. These are your everyday, tried and true businesses. That's what makes them dividend aristocrats. They're reliable. Now, each of these dividend aristocrat companies has their own unique dividend yield. The typical dividend yield for any one company on this list is a little bit over 2%. But as with any average, some pay out more and some pay out less. AT&T currently has the highest dividend yield on the list, coming in at 8.43%. And with its current share price of $24.66, that means it has an annual dividend payout of $2.08. ExxonMobil has a hefty dividend yield coming in at 5.47%. And with a current share price of $65.02, that translates to an annual dividend of $3.55. And let's do just one more. Walmart has a dividend yield of 1.54%, and with its current share price at $143.17, that means its annual dividend is $2.20. So how much would you need invested in each of these companies in order to earn $40,000 a year in passive income? For AT&T, you would need $474,000 invested. ExxonMobil, $732,000. Walmart, $2.6 million. And our original example, 3M, you would need over $1.2 million invested. It's easy to see that you need drastically different amounts invested to achieve the goal of the annual income of $40,000. Generally speaking, the higher the dividend yield, the less you need invested in order to capture a more significant dividend payout. Which begs the question, why not invest everything you have into a company like AT&T and then capture that sweet, sweet dividend income and retire early? Because after all, if you were to follow the rule of 4%, a nest egg of $475,000 would net you just $19,000. Why not just invest in AT&T, grab your $40,000 in dividend income and call it a day? Well, that approach comes with a significant degree of risk. Do you really want to put all of your eggs in one basket with one company, in this case, AT&T? Personally, I don't want to accept that level of risk. I don't want to put all of my faith into one company, no matter how well known or how reputable it is. After all, it's important to remember that dividends are not guaranteed. What if a company begins to struggle? They can cut or suspend their dividend at any time. What if a global pandemic happens? A company loses its workers and its profits. They can, and many did, cut their dividend. It's also worth noting that AT&T is going to be undergoing some structural changes that are almost certain to lead to the company cutting its dividend in 2022, meaning it will no longer be an aristocrat. So even those aristocrats are not untouchable. So rather than simply invest in one company, you could choose a handful of these dividend aristocrats or simply invest in an ETF or an index that tracks them. You know that saying, there's an app for that? I feel like nowadays you can use it for there's an EFT for that, or there's an index for that, don't you? No, just me. I'm the only nerd. I get it. But there is indeed an EFT that tracks this group of reliable dividend-paying stocks. It is the ProShares S&P 500 Dividend Aristocrats ETF, ticker symbol NOBL, Noble. Get it? Because they're noble, like royalty. The dividend yield for this ETF is 1.54%, which means you would make roughly $1.87 for each $96.15 share you own. So if you wanted to make $40,000 a year as an annual income, you would have to have a little bit over $2 million invested, a fairly hefty sum to be sure. Now, of course, the dividend aristocrats with their solid and reliable dividend payouts aren't the only routes when it comes to dividend investing. As I mentioned before, there are different dividend investing styles. For instance, you could go with a company like Vale. I'm not trying to be fancy, that's literally how it's pronounced. Their stock is currently selling for $11.81 a share, and it has a massive dividend yield of 22.32%, which would translate to $2.64 for each share held. Meaning if you invested $179,000, you could theoretically earn $40,000 a year in dividends. So why don't we all do this and retire today? Well, you might notice a slight trend with this stock. Seems to be in quite the declining state. Such a high dividend yield is likely unsustainable. Companies can and do hike up their dividend yield in order to track these dividend-chasing investors. And it can work in the short term. But it's important to note that these dividend-chasing investors aren't investing in the company. They buy the stock in order to capture that dividend payout, but then they sell just as quickly as they bought. Eventually, these sky-high dividends do end up being cut, brought back down to realistic levels, or even worse, eliminated. Just know that if this is the investing style you choose, you're going to have to be careful not to get burned, as you will frequently have to trade from stock position to stock position as you're continually trying to chase down that next high dividend payout. And of course, there are a number of ETFs that track high yield dividend paying stocks. And of course, they still experience volatility and turnover, but they can certainly help to mitigate your risk. My favorite company in the world, Vanguard, offers one as well. Of course, being the stand-up and reputable company that they are, even their high yield dividend paying ETF only has a yield of 2.79%. But if you were to invest a little over $1.4 million, you could earn yourself an income of $40,000 a year. Still a sizable sum to be sure, but that's significantly less than you would need invested in the Aristocrat ETF. It all depends on your risk tolerance. It's important to keep in mind that the dividend yield of these high yield dividend paying stocks is likely to be more volatile, and so too is the stock price. Which one's the best choice to invest in? Well, that's your personal choice. And you might be wondering why I constantly use $40,000 in each of these examples. Well, that's because if certain conditions are met, the income an individual receives from dividends, up to $40,000 for an individual or $80,000 for a married couple filing jointly, is actually able to be claimed completely tax-free. Would that be enough for you to retire on? Well, that's up for you to decide, because after all, finance is personal. So what do you guys think about dividend investing? I personally have mixed feelings on it, but that's for a different video and a different time. I'm gonna wrap this one up here. I post new videos every single week, always on a Monday, sometimes on a Thursday. If you got anything at all out of this one, please hit the like on the way out. If you're new here, please consider subscribing, or if you know of anyone who might get something out of this type of content, please consider sharing, as it really does help out the channel. I hope you guys have a great week, and I'll see you soon. Bye.